Hello, I'm Alex Davies, the founder of Wealth Club. Today I'm with John Glencross, CEO of Calculus Capital. Hello, John.
Alex, good afternoon.
First off, can you just tell me a little bit about Calculus and your own background?
Well, Calculus was founded 20 years ago, and the founders, of which I was one, are still very much involved with the business. Clearly we've grown substantially since we started in a basement 20 years ago. We are investors in predominantly later stage growth companies. We are, as they say, multi-award winning, and we have EIS and VCTs.
So what does the EIS aim to do for investors?
We focus on the later stage growth part of the market, where our companies generally will already have products which are in the market or services which are in the market. They've already shown a capacity to stay the course. I think I would draw a distinction between, say, early stage, which is a higher risk, possibly higher return model, compared to where we are. We think that that particular part of the market has the right risk return profile for our investors.
Are there any particular sectors you focus on?
Well, that can vary at different times, clearly, but I think the themes that we would highlight are investing in healthcare, in business to business, technology-enabled companies. And by technology-enabled companies, I mean companies that are not doing revolutionary things. They're usually doing some very some rather key business services, but they will be bringing technology to bear such that they can sell their business usually on a hosted basis globally, and also generally using technology more efficiently and also more cost effectively. So technology-enabled businesses, and another area that I might highlight is maybe advanced manufacturing. Again, bringing technology to bear on what you might call an established area of activity.
And is there any sort of difference in the types of companies you look for the VCT and the EIS?
No, I mean the probability is that both our EIS and our VCT will invest in the same companies. That means that both have access to quite substantial deals. Our normal investment size would be 2.5 to 5 million, so that both our VCT and our EIS can participate in those deals. We have a common investment strategy across our EIS and our VCT. Which is the more suitable investment, whether it's EIS or whether it's VCT, really depends upon the investor, their situation, what they're looking for. The attractions with EIS are obviously one of the drivers in recent years has been inheritance tax and inheritance tax exemption. VCT, obviously the big attraction of VCT is, of course, both have the upfront income tax but the tax-free dividends, and if you are a higher rate taxpayer with a substantial regular income, the tax-free dividends are very attractive. So it's really a question of what suits the investor. They have a common investment strategy.
And can you talk to me about some of the recent investments you've made?
Well,
and why you chose them as well. Yeah.
I think, having said that we started 20 years ago, even after 20 years, I still can get excited about investments, and some that I would mention that we have invested in recently, Weeding Technologies. Weeding Technologies now is being recognized as having, by some parties, the world's leading environmentally friendly alternative to products like Roundup, which is a product of Monsanto used for weed control, particularly weed control in public spaces, where there are some concerns about those products and indeed some legal action. Weeding Technologies has an environmentally friendly way of treating, of dealing with weeds in public places, and clearly if you are a municipality, local authority, even a government, you are quite concerned about public spaces, particularly where there are children, that you should be using environmentally friendly methods rather than those which may allegedly be carcinogenic. So Weeding Technologies is a very interesting company selling globally. Now it's selling in the United States, it's selling in Europe, it's selling in the Far East. Another one I would mention is Simpronics. Simpronics has technology which is used in gene therapy. In gene therapy, it tells the therapy what to do. It directs it to the right areas, which clearly is critical. So they are now recognized again as one of the world's leading companies in what's known as promoters, which is the science that tells the genes in gene therapy what they should be doing, and they are selling in the United States, they are selling in Europe. Incredible company, incredible science, and being recognized globally. Another I'd mention is Gene Drive, which is a company that's known for having the world's first rapid molecular test for hepatitis C. One of the things I find very interesting is it's always said it's very hard to break into the NHS. In fact, I mean, I've heard that even said by people recently. Interestingly, Gene Drive has a test, a rapid test, it can be done in under 60 minutes, to test for a genetic mutation in infants, in babies, which can lead to deafness if treated with certain antibiotics. Now clearly if a baby needs treatment quickly, you do not want to have to send a test to the lab and get it back 24 hours later. But the consequences of treating with the wrong antibiotics can be so horrendous. So Gene Drive has actually very quickly been engaged by the NHS in a multi-site trial for that particular test, for that genetic mutation in babies. So, I mean, to my mind, as I said, even after 20 years, I think some incredible companies, very exciting, great prospects. What I would say, and maybe we can elaborate on this, that investment alone is not enough. I mean, we long ago recognized that we have to work with these companies, that whatever their potential, we have to work with them in partnership to deliver on that potential for our investors.
And how involved do you actually get?
Well, I think it's something that we have developed over the years, and we regard it as a partnership. I mean, I would say that the funds that we provide are at best only half the equation. We work with our companies both to try and mitigate unnecessary risk. Remember, these are growing companies, so we try to work with them to take out risks that can, with experience, be avoided, and also to capture as much of the upside as possible for our investors. So it can be anything as mundane as better cash flow planning, better forecasting, through to introductions to contacts we might have that would help with their marketing, assistance with distribution. It doesn't matter what your product is or what your service is. If you're going to sell globally, you have the challenge of how do you distribute that. So we can help them with that, with our contact, with our experience. And obviously, key areas such as helping them recruit key members of the team. So we very much regard it as a partnership, and we very much regard the funds that we provide as only part of the equation.
So let's talk about exits, which is the thing that matters to investors. Have you had them? Can you talk about a few of the successful exits you've had?
Ultimately, it is all about exits. A successful investment will only be judged by its exit, and whether it's delivering capital returns to our EIS investors or the tax-free regular dividends to our VCT investors, clearly it's very important. We have had 33 exits. In fact, it's a little higher now with some recent ones, but we haven't processed all the figures relating to those yet. They've been quite recent. But we have had 33 exits, and of those, over 60% have been profitable exits with You can cut these numbers various ways, and I recognise that, but on average a 2 times cash return. And I think that figure of over 60% profitable exits within the sector is actually recognised as a very good level of return. So we focus a great deal on exits. We focus a great deal on the whole process. I mean, clearly they can come in many ways. The most likely is trade sale. We will recognise that sometimes we are part of the what you might call the food chain, i.e. we will sell to a larger fund, and they will take over, and they will take that company again to a different level, and with larger funds, or through IPO. And I mean, you know, we have experience in house of looking at both AIM and indeed Nasdaq.
And do you have a target return for the EIS?
We have a target return across our funds, which is actually, we aim for 2.5 times cash return. People talk about IRRs, but it all gets very, that can get very convoluted. I mean, in a very straightforward level, we aim for 2.5 times.
So if I invested this year, when in your EIS, this is, when would I be hoping to start seeing some of my money back in?
Well, you know that with EIS, you need to hold the investments for 3 years in order to retain the tax reliefs. That is the requirement of EIS. It's a different set of rules for VCTs. So I mean, we are thinking about exit at the time of investment. It is part of our investment process to think what are the likely exits, who are the likely buyers. And indeed, having said that most exits will be trade sale, we will be thinking about that 18 months beforehand, and thinking, well, who is it that we need to be on the radar screen? Because if they're already aware of you, you're starting to warm the process, etc. So, but really, these companies you have to hold for 3 years in EIS. They are growth companies. It is a fact that really it takes 3 years to 4 years for these companies to mature and deliver their potential. And actually, even though the rules don't require that whole period for a VCT, it's still the nature of the companies that you are looking to a hold period that might be 4+ years in order to achieve all the potential that you hope to achieve in the whole period of those investments.
And how risky is it what you're doing compared with, say, the universe of EIS funds? Are you right up there, or would you like to think it's a sort of different level of risk?
Well, I like to think it's a different level of risk, and indeed I think it is. I mean, as I said, we invest in what I'd call later stage growth capital. We are not early stage investors. That is a different type of investing. I think statistics and history shows that really in that area, an investor needs a portfolio of 30+ investments, because it's going to be a handful that deliver hopefully stellar returns which make the overall performance acceptable. Where we are in the market is a different level of risk return. We're not aiming for those stratospheric returns, but the risk commensurate with that investing is different. So I think, as I said, our risk return strategy, or where we are in the market, is appropriate to our investors. How risky is it? I mean, the important thing is to, I feel, EIS VCT, invest with a fund who are experienced, who have a track record, who have shown that they can deliver on that track record. But also, what's very important is, and everybody talks about proprietary deal flow. I mean, everybody does. What I would say is, if you've been in the market for 20 years, you have a lot of contacts that know that if they come to you, they come to us, they are going to deal with a firm that's efficient, it is straightforward, it will give them a fast response, whether it is something potentially of interest or not. And although we have a very thorough process, we aim to be as efficient as possible in terms of achieving our investments. So it's clearly it's more risky than government bonds, but I think done well, the risks, particularly where we are in the market, can be certainly overestimated.
And if I'm going to invest in a VCT or EIS this year, why should I invest with you?
Well, that's a very good question. I think we are experienced. We've shown that we can deliver for our investors. We aim for diversification in our portfolios, and our particular risk model of later stage investing is, I think, appropriate for many, if not most, investors. Perhaps the one thing I would point to, having said that we were founded 20 years ago, is we have investors today who are investing with us today who invested with us in our first fund 20 years ago and have been regular investors throughout. And I think within the industry, within the sector, we are recognized as having a significantly high level of repeat investors. And I think the fact that we have investors who have been prepared to invest with us over many years, repeat investors, regularly have trusted us with their funds, is probably what I would point to as perhaps most telling in why an investor might look at, whether it's the VCT or EIS, might look to invest with Calculus.
John Glencross of Calculus Capital, thank you very much.
Alex, thank you.